Hi, and thank you for joining us today for our first ever copper conference. We have an amazing lineup of companies for you to watch and learn from, including 2 copper producers and 2 developers. First up is Peter Kukielski, President and CEO of Hudbay Minerals. Hudbay produces 200 million pounds of copper annually at their flagship Constancia mine in Peru. Hudbay also has the Snow Lake operations in Manitoba, which produces copper and gold, and an advanced stage development project in Arizona called Rosemont. Then we will hear from Darren Pylot, President and CEO of Capstone Mining. Between Capstone's 2 producing mines, they produce 180 million pounds of copper annually. Capstone's flagship mine is Pinto Valley in Arizona and produces 130 million pounds of copper, with the balance coming from the Cozamin mine in Mexico. Capstone also has a development project in Chile called Santo Domingo that is fully permanent and ready for construction. Then we are going to hear from Tony Giardini, President and CEO of Trilogy Metals. Trilogy Metals is an advanced stage developer in Alaska and is in partnership with South32 in developing the Arctic project, which is a VMS deposit with high-grade copper. This summer, Trilogy Metals is undertaking the most aggressive drilling campaign in its history and will be spending $27 million to drill 55 holes throughout the district. Next up is Paul West-Sells, President and CEO of Western Copper and Gold. Western Copper owns the Casino project in the Yukon, and Casino is a large-scale bulk tonnage project. Rio Tinto recently made a $25 million investment in Western Copper, and we will hear the details behind the investment. The conference concludes with a few words from Cailey from BlackRock from a previously recorded interview. Cailey touches on copper valuations and also country risk. The full interview can be found on our YouTube channel, Bloor Street Capital. If you have any questions for any of the presenting companies, or if you would like research on any of the companies, please send us an email to info@bloorstreetcapital.com. That's info@bloorstreetcapital.com. We will also have an open chat on the right-hand side of your screen, so you can ask questions there, or you can leave a comment. If you can't watch this conference in its entirety, we will have a replay available at the conclusion of this conference on our YouTube channel, Bloor Street Capital. I hope you enjoy the conference, and thanks again for your support. Peter, thanks for joining us. It's good to see you again.
Thanks very much for having me, Jimmy. It's a great pleasure to be here.
Peter, before we do a deep dive on your operations, why don't we just start with a brief overview of Hudbay Minerals?
With pleasure, Jimmy. So we're a diversified copper miner that's focused on low-cost, long-life assets in the Americas. Copper is very much our primary metal, but we also offer investors increasing exposure to gold. In Peru, we have our flagship Constancia mine with a high-grade copper-gold satellite pit called Pampacancha that we started mining at the end of April. In Manitoba, Canada, we have our 777 mine in Flin Flon that's been in operation for over 17 years. And we have the Lalor gold zinc copper mine in Snow Lake, where we're expecting to significantly increase gold production through the completion of the refurbishment of our new Britannia gold mill this year. In the United States, we have Rosemont in Arizona. It's a top-tier copper development asset that was recently stalled by an unprecedented court ruling, and we're currently appealing that decision alongside the United States Department of Justice to overturn it. We've recently made an exciting new exploration discovery on our private land near Rosemont, which we call Copper World, and we believe this has the potential to be a world-class copper asset that is certainly the best discovery that Hudbay has made since the Lalor discovery in 2007. We also have the Mason Copper Project in Nevada, where we've just released a positive PEA that outlines a 27-year mine life and attractive project economics at a $3.10 long-term copper price. And in addition to these properties, we have an extensive portfolio of exploration assets in the Americas that I believe provide us with substantial optionality. But most importantly, I think ore bodies aren't made or aren't much use without the right people. And I truly believe that at Hudbay, we have a disproportionately talented team for a company of our size. So there you have us, Jimmy.
That's a great overview, Peter. And as you mentioned in your intro, your flagship property is Constancia, which is in Peru. It produces approximately 200 million pounds of copper annually. And you just recently started processing ore from a satellite deposit called Pampacancha. And that's really changed the economics of Constancia. Why don't you touch on that and just tell us about how that's improved the economics?
Certainly. So for background, Pampacancha, as you say, is a high-grade copper gold satellite that's located some 5 kilometers from our Constancia mine and mill. The copper grade at Pampacancha is double the copper grade at Constancia, and the gold grade is nearly 10 times higher. So as you say, we achieved first production in April, which is consistent with our annual guidance. The Pampacancha pit has approximately a 4-year life. During this period, about 1/3 of the production at Constancia will come from Pampacancha, which will bring Constancia's annual copper production to over 200 million pounds. So due to these higher grades, our C1 cash costs are expected to significantly decline over the next several years to below $1 per pound of copper, net of byproduct credits, which compares to around $1.45 per pound last year.
That's huge improvements to go from $1.45 down to $1, so massive margins there.
Yeah, indeed. We're pretty excited about it, and there's more.
So, Peter, as you mentioned, you're going to have ore coming from Pampacancha for 45 years, 4 to 5 years, and then you're going to have to replace that. And I'm assuming you're going to do that through exploration work at Constancia or through regional exploration. Why don't you touch on that?
Certainly. So we've recently announced a larger and higher grade reserve estimate at Constancia, which incorporates the Constancia North pit extension and improves the production profile beyond Pampacancha. This results in an expected average annual copper production from Constancia of some 220 million pounds over the next 8 years at first quartile cash costs. And beyond this, Constancia North remains open to the north, and there remains further exploration potential to convert additional resources to reserves and potentially extend the resources through an underground operation, which of course would be nothing new to us. So beyond what's in the ground, we have a highly skilled and creative team at site that has successfully and continually increased throughput beyond Constancia's nameplate capacity, and I have no doubt that the team will continue to do so. And then there's technology. We'll continue to deploy technology to offset grade decline over time to enhance our longer-term production profile. And then I'd be remiss in not mentioning that Constancia has strong potential to extend mine life through exploration on our prospective satellite land packages. We have every intention of demonstrating that what we do in Peru will mirror our history in Manitoba, where there's not a single mine that we've operated over our 100-year history where we didn't extend reserves materially over time. But perhaps I'm getting ahead of myself, but when you pose the question of what's next, I can't help but point out that our exploration programs at Hudbay are absolutely results oriented. So consider our discovery of the 1901 deposit in 2019 in Manitoba, or our continued expansion of gold zones and resources at Lalor, or more recently our Copperwell discovery. These discoveries should offer a sense of what I'm talking about, and I expect no less in Peru. I spoke about talented people. Well, we have one of the best exploration teams I've worked with. And these folks truly know how to work with their operations counterparts to generate creative outcomes. So there's a lot of good stuff on the Constancia horizon, I believe.
So you mentioned a few other satellite deposits outside of Constancia. I believe you've identified 5 mineralized deposits, all within trucking distance. Can you just touch on those and just tell us what you're going to do in terms of exploration this year and what your budget might be?
Yeah, so I did get a little bit ahead of myself. Look, I do believe that we have one of the best exploration portfolios in Peru. The tenements we have are located close to Constancia and have the potential to host a world-class copper deposit, possibly much larger than Constancia. We're particularly excited about Maria Reina, which sits on a line that joins Las Bambas and Tintaya, and which has a radiometric footprint that is not dissimilar to these mines in scale. Another reason why we are so excited about Maria Reina is that Vale historically drilled the property and intersected over 500 feet with 1% copper equivalent from surface. So we're in the process of discussing an exploration agreement with the community, and once an agreement is reached, we'll complete the remaining regulatory process required to obtain our drill permits, which is about a 12 to 18-month process. We did recently complete this process at our Coincha North exploration target, and we've started drilling there. Now, I should point out that we have a strong community relations presence in Peru, and our deliberate but patient approach has earned us a strong social license there. This was demonstrated by our recent success at Pampacancha, and we believe that the Pampacancha land acquisition process has provided the opportunity to unlock the potential in these other satellite deposits, as these communities now have an idea of what to expect if we're successful in exploring and finding something economic to exploit. So beyond Constancia, we have the Llaguen property in northern Peru, where we expect to commence drilling activities in the coming weeks. Llaguen is a copper porphyry target that we optioned from Vale, and it's located near the city of Trujillo at lower altitude and in close proximity to existing infrastructure. So given the prospective land package we have in the country, together with our expertise in community relations and successful exploration, I'm pretty confident we'll be present in Peru for many years beyond the current 17-year mine life.
So Peter, we cannot have a discussion on Peru without discussing the current political situation. And this is something you're very familiar with, given your current position, but also previous jobs in Peru. And I'm curious just to hear your views on the political landscape and what it means for the mining industry overall.
This is a really interesting question, Jimmy. Let's start with a little context. Mining is incredibly important to Peru. About 10% of Peru's GDP comes from mining, and mining accounts for half of Peru's export income and around 1/4 of foreign investment into Peru. This said, I've worked in or been associated with Peru since 1997, and during that time, we've seen a number of administrations. Almost every time there's an election, there's polarization between the left and the right, and there's lots of noise and rhetoric accompanied by a sense of impending doom if the candidate on the left is elected. Yet when in 2011, the far left candidate, Ollanta Humala, was elected, he understood the importance of mining. Yes, he did tinker with the fiscal regime somewhat. However, he offset these changes, and in our case, with accelerated depreciation. So what's different today? The pandemic is the difference, and it certainly has had a significant economic impact on many countries. We've seen pressures to increase mining taxes in several regions, not just Peru, you mentioned Chile, but we've also recently seen higher proposed taxes in Nevada. But I come back to one principle that we follow at Hudbay. We invest in investment-grade countries in the Americas. We don't invest in countries with confiscatory regimes. Peru and Chile account for nearly 40% of global copper supply, and even today, we would rather be in these copper regions than in the other half. At the end of the day, these will continue to be copper countries. And as I mentioned, Hudbay has a strong social license in Peru. Constancia has successfully operated through several administrations, and we expect to work constructively with the new administration and to continue to focus on our operations and our communities. And the bottom line is that we believe Peru will continue to play an important part of Hudbay's future.
That's a great overview of Constancia and also Peru. Thank you for that, Peter. Now let's move on to your Canadian operations, Snow Lake. You're currently undergoing a major refurbishing of the new Britannia gold mill, and that's going to result in significantly higher gold recoveries. Why don't you give us an overview of Manitoba?
Certainly. So for those who are not familiar with our new Britannia mill that you just mentioned and our Snow Lake mining operations in Manitoba, our Snow Lake operations consist of a Lalor underground mine that has been in production since 2014 and has steadily increased and optimized production rates over the past several years. While it was traditionally a base metals deposit feeding our Stawell base metal concentrator, Lalor is transitioning to a primary gold mine as we complete the refurbishment of the New Britannia gold mill in the middle of the year. The New Britannia refurbishment project is over 80% complete, and first gold production from the gold circuit is expected in early Q3. We also are constructing a new copper flotation circuit at New Britannia to maximize copper recoveries from Lalor, and the copper circuit remains on track for commissioning and ramp up in the fourth quarter of this year. Now, we're always looking to continuously optimize our Snow Lake operations. So, for example, we're currently implementing technology to increase recoveries and throughput at Stall. We've converted additional resources to reserves at Lalor. We have plans in place to expand Lalor to 5,300 tons per day by 2023 from 4,500 tons per day today. And we've incorporated the nearby 1901 deposit into our Snow Lake mine plan. So as a result of executing our Snow Lake gold strategy over the past several years, we've steadily increased the annual gold production from 140,000 ounces to 150,000 ounces, and now to over 180,000 ounces at approximately $400 per ounce C1 cash costs over the next 6 years, as indicated in our recent updated mine plan, which we released at the end of March. But that's not the end of it. We have a history of resource conversion and discovery, and we have every reason to believe that there's substantial upside beyond the current mine plan. We've historically converted 80% of our resources to reserves and have several areas to further expand Snow Lake resources. So we believe we have the potential to increase gold production to over 200,000 ounces per year. I should also point out that Lalor is a VMS deposit, and it has similarities with other mature VMS complexes which have extended mineralization at depth over decades of exploration. Agnico Eagle's LaRonde mine is an example. Lalor is a fairly recent operation and has only been explored down to 1,200 meters depth, which is less than half the vertical extent of LaRonde. So we have every reason to believe that there's much more to come as we continue to explore at depth in Lalor. Separately, over the past few years, we haven't held back on brownfield or in-mine exploration, but because of our growth capital spend, we've been far more reserved in greenfields exploration. We're now resuming some of our greenfield exploration in Manitoba, which, as you can imagine, has the potential to yield some interesting results. So this said, our Snow Lake operations currently have a 17-year mine life, but I'd be surprised if this doesn't become at least a quarter-of-a-century operation.
So we've touched on Peru, we've touched on the Canadian operations. Why don't we move to Arizona, where you have a very active pipeline? I'm sure a lot of our viewers are familiar with Rosemont. It's currently on hold because pending an illegal decision. So maybe you can just give us an update on Rosemont, and you also have a very active exploration program there with Copper World. So let's talk about that also.
Certainly, Jimmy. So for those who don't know, our Rosemont Copper Project is located in Arizona. It's a top-tier copper development asset that was recently, as you said, stalled by an unprecedented court ruling, where we're currently appealing alongside the United States Department of Justice to overturn the judge's decision. We expect an appeal decision in the second half of this year, but we've not stood still in Arizona. So we recently made a very exciting new exploration discovery on our private lands near Rosemont, which we're calling Copper World. And we believe this has the potential to be a world-class copper mine in its own right. There's no doubt that this is the best discovery Hudbay has made since the Lalor discovery back in 2007. But overall, we believe that we have three of the best undeveloped copper deposits in our portfolio, namely Rosemont, Copper World, and the Mason project in Nevada, which is our longer dated project. These deposits provide the potential to substantially grow our production profile and add meaningful long-term value for shareholders. But we are super excited about Copper World, and we've been very, very encouraged by the drill results that we've seen there to date. It contains higher grades than Rosemont. They're located much closer to surface. For example, one of the drill holes that we drilled intersected 440 feet of copper at 1.38%, including 70 feet at 4.2% of copper. We've identified 4 deposits at Copper World, all located on our private land, which simplifies the permitting process, of course. Now, I visited the area back in April, and honestly, one can see signs of surface mineralization everywhere you look. So I can understand why our exploration team is so excited about Copper World.
And Peter, let's just touch a little bit on how much money you're going to spend on it this year. What's your drilling budget? How many rigs are you going to have going at Copper World?
Sure. Our drilling budget is $24 million for Copper World this year, which increased from the initial $10 million we budgeted at the beginning of the year due to the continued strong results that we've seen from the 2021 drill program thus far. We expect to drill some 150,000 feet this year, which is significantly higher than our 2020 drill program of 40,000 feet. We expect to publish an initial inferred resource estimate before the end of the year, but we're also spending an additional $10 million on various studies to support the completion of a PEA in the first half of 2022. And in that sense, to support all this work, we have 5 drill rigs operating at site right now, which is an increase from the 3 that we had at the start of the initial 2020 drill program.
And I'm sorry, Peter, how far is this from Rosemont?
Approximately 6 kilometers, Jimmy.
And I know it's still early days, but do you see this as being a standalone project?
Copper World certainly could be a standalone project, or it could be developed in conjunction with Rosemont. And the timelines to production are likely pretty similar in the 2 scenarios. So depending on the results from the exploration and the PEA work that we do, we could have a PFS completed by the end of next year and a definitive feasibility study completed in 2023. So it's likely a 3-year build. So production by 2027 is not unreasonable to consider.
And so you have a lot going on in your pipeline. You have Rosemont, you have Copper World, you also have Mason. Do you think the market's giving you any value for these assets?
Jimmy, I believe that there's very little, if any, value in our share price for Rosemont, let alone for our other United States assets at Copper World and Mason. I mean, Copper World has its name for a reason. And Mason has a 2.2 billion ton resource that our recent PEA indicated drives an NPV of over $500 million at a long-term copper price of $3.10. And so I'm sure you get a sense that our use of $3.10 for long-term pricing should tell you that we're conservative when it comes to project evaluation, and we're not given to hyperbole. So I really do believe that our share price does not reflect the value of these assets.
And Peter, I'm glad you brought up Mason, because that was acquired. That was one company that you had made an investment in, and then you eventually took it over. But one of the things I've always admired about Hudbay Minerals was its toehold strategy, whereby it would make small investments in various junior exploracos. This is how you acquired Constancia and also Rosemont. And is this a strategy you intend on pursuing?
Yeah, Jimmy, our toehold strategy has been an effective way to have exploration exposure in many different early stage assets while committing minimal amounts of capital in the form of small equity stakes. We also typically offer our exploration expertise to the junior company. For example, we can help with geological or geophysical interpretation to identify and prioritize exploration drill targets. So the strategy has proven successful for us and gave us toeholds, as you say, in Constancia and at Rosemont and at Mason before we fully acquired these assets. But we have been a little bit less active in recent years as there were limited junior opportunities, and we were more focused on exploring our own land package. We look at our capital allocation opportunities holistically, and toehold investments are evaluated together with in-house exploration opportunities. And given our recent exploration successes, we've recently focused more on organic exploration. But that said, the toehold strategy has historically paid off for Hudbay, and we certainly will continue to look for the right toehold opportunities.
And I'm just curious, what investment criteria do you look for before you make an investment in one of these junior exploracos?
Yeah, as I mentioned, we look at these in conjunction with our exploration portfolio. So all of our toehold investments go through the same screening process as any capital allocation opportunity. The assets need to have characteristics that meet our overall strategic criteria, including being located in mining-friendly jurisdictions in the Americas, copper-focused, and have the potential to ultimately leverage our proven core competencies of exploration, mine development, and efficient operations to drive value.
Peter, just one more question before we wrap it up, but I want to get your views on consolidation and also M&A. We've seen a little bit of M&A activity in the precious metal space, not a whole lot, but we've seen very little in the base metals. And maybe the last large deal we saw was with Nevsun, your former company. But what are your thoughts on this? Are you surprised we're not seeing more activity?
To me, I'm not really surprised. There really is a scarcity of complementary base metals assets. So you've got the bigger guys, you've got the smaller guys, but you really have a scarcity of companies or assets that you can combine to create not only scale, but also synergies and growth of value. So no, I am not surprised at all, and I still scratch my head a little bit as I try to figure out where the next combination will come from. But that said, we are always looking for opportunities, and we need to be creative to determine how we can, in fact, create scale in the industry, drive shareholder value through combination or through acquisition. But there's not a lot out there.
Peter, as we wrap up, why don't you just tell us what we can expect in terms of news flow in the coming weeks and months?
Certainly. Look, there are lots of exciting near-term catalysts at Hudbay. So in Peru, we expect to receive results from our Coincha North drilling program in the coming months. We'll begin drilling the Giardini property in the second quarter. We expect to be advancing the exploration permitting process at the other regional Constancia properties this year once we reach a community exploration agreement. And we intend to complete a trade-off study for the Constancia North underground operation before the end of the year. In the medium term, we expect to advance our work on examining further areas of optimization at Constancia, including the use of ore sorting technology and copper recovery improvements at the mill. Then in Manitoba, we expect to complete commissioning of the New Britannia gold mill in the coming months, and we expect to pour first gold early in the third quarter. We then expect to commission and ramp up the New Britannia copper circuit in the fourth quarter. We've started the work in preparation for the ramp up at Lalor to 5,300 tons per day, and the Stall Mill recovery improvement program has been kicked off. We'll also continue this year's exploration program in the Snow Lake region. Then in Arizona, we look forward to releasing further exploration drilling results to potentially extend the mineralization at Copper World, to publish an initial resource estimate before the end of the year, and work towards a PEA to be released in the first half of next year. We also expect to receive a decision from the Ninth Circuit Court of Appeals on Rosemont in the second half of the year. And at Mason, we'll continue to advance early exploration work in preparation for a future drilling program. Finally, we've been very, very focused on delivery over the past couple of years, and we're now on the cusp of seeing our deliberate and thoughtful investments paying off through very significant increases in cash flows. And 5 to 6 years from now, we expect to enjoy a significant chunk of copper production coming from our United States business. So I believe we are very well positioned for the strong copper market ahead of us, and I feel that the future is extremely promising for us at Hudbay.
Well, you and your team are going to be quite busy in the coming months.
Indeed we are.
Well, Peter, that was a great overview of the Hudbay Minerals story. I want to thank you for sharing it with us. And to all the viewers, if you have any questions or questions that were not answered during this discussion, please send us an email to info@bloorstreetcapital.com, and I'll make sure a member of Peter's team reaches out to you. And if you would like some research on Hudbay Minerals, please send us an email and we'll send that along. Once again, Peter, I want to thank you.
Thank you so much, Jimmy, and thank you everybody else for listening in. It's been a great pleasure to be here today.
Darren, thank you very much for joining us today.
Thanks, Jimmy, and good afternoon. Great to be here at the conference.
Darren, the past year has truly been a transformational year for Capstone Mining, just in terms of production, profitability, and also the share price. And before we dive into all of those elements, why don't we just start with a brief overview of Capstone Mining?
Sure. Well, Jimmy, Capstone is a base metal producer focused on copper. We own two operating copper mines, our Pinto Valley mine, which is located in Arizona, and our Cozamin underground mine, which is located in Zacatecas, Mexico. We also own 100% of a copper project called Santo Domingo, which is located in Chile. And it is a fully permitted large-scale copper iron project located in the third region in Chile. And it's at low altitude and in a growing mining district about 100 kilometers from the port that we also own there as well. Our strategy at Capstone is to build a sustainable multi-asset copper mining portfolio company, which all assets are in a prolific mining jurisdiction and which is friendly towards miners as well. We invest in new technologies to help us drive costs lower. We operate in a safe and environmentally responsible manner in each of our operations and assets that we own. In 2021, we expect to produce about 185 million pounds of copper at C1 costs of $1.80 per pound. And this production is expected to grow to over 200 million pounds of copper in 2022 and 2023, thanks to higher grades at both of our operating mines. In addition, we are currently in partnership discussions to fully finance construction of the Santo Domingo project. We are targeting a 50 to 70% ownership at Santo Domingo, and this would increase 2024 copper production at our assets to over 100% relative to today, and at lower C1 costs down to around $1.15 to $1.20 per pound of copper on a consolidated basis. So as you can see, Santo Domingo offers investors transformational growth potential.
Darren, as you mentioned, your flagship property is Pinto Valley in Arizona, and a big reason for Capstone's success in the past year has been because of the optimization program that you and your team referred to as PV3. Maybe you can just touch on some of these optimizations that you've made here in the last few years.
Sure. Well, Pinto Valley's current mine life extends out to 2039 in a mine plan that we currently call PV3. We're also currently conducting a PV4 study that will be released next year and is targeting a mine life extension into the 2050s. With over 1 billion tons of resource at similar copper grade to our current reserve grade, our strategy there is to apply new technologies to get brand new performance out of our vintage 1970s operation. And so really there are 3 key technologies that will be incorporated in the PV4 study. And we're using some of those now, predominantly the number one, which is predictive blast fragmentation. And that really allows us to put significantly more fines generated from the mine through the mill. And that reduces our crushing and grinding costs as well as our maintenance costs significantly. It allows for higher throughput as the increased fines generated in the mine pass through the mill much faster. Our second technology is what we call our Aries hydrofloat coarse particle flotation technology. And this has been pilot plant tested at Pinto Valley late last year with excellent results. We realized about a 6 to 8% increase in overall recovery, up towards 90%, which equals new mill performance and is impressive for a low-grade copper porphyry. The feasibility study on this technology is expected to complete in early Q3 of next year. And the third significant technology is what we call the Jetty Resources catalytic leach technology. And it's a technology that Capstone is pioneering and that other companies are also recently announcing testing on as well. We have at Pinto Valley a huge, large historic stockpile at an estimated 1 billion pounds of copper with an underutilized copper cathode plant. This stockpile, plus the addition of low-grade mineralized waste, is expected to deliver up to 350 million pounds of copper recovery over the next 18 years. Low-cost recovery of copper from what would otherwise be waste is a very big win for Capstone, in my view.
Darren, I'm not a mining guy, I'm a finance guy, but I'm always amazed at when you can incorporate new technologies that have big improvements, like when you just mentioned predictive blast technology. I find that quite interesting.
Yeah, as I said earlier, our plan is to, and our vision is to, instead of writing a check for $1 billion brand new plant at Pinto Valley, we can make our old 1970s plant run just like a new one by doing these low capital, high return, new technology projects that will enable the mine to run like a brand new mine without running that large ticket expense in terms of capital.
Darren, you touched on your next optimization program, which you referred to as PV4. What's going to be the big differences between PV4 and PV3?
Well, the target for PV4 is to produce a mine plan with an average annual production rate of around 160 million pounds of copper per year for the next 30 years. So significantly longer mine life, and you're going from 135 million pounds up to 160 million pounds of annual production. And that would surface over 2 billion pounds of copper production versus what we have in our current PV3 plan. And as I mentioned, we aim to use technology to deliver this growth by leveraging as much as possible from our current infrastructure. For PV4, we are conducting column leach work for an expanded leach scenario to allow for higher mill cutoff grade. And that would allow more throughput through the mill at higher grades as well.
And Darren, because of this, the increased size of PV4, do you foresee any issues with labor or permitting, water?
Well, the PV4 study, as I mentioned earlier, will be released early next year, so it's still a little early to get specific. But we do know that a longer mine life would need a new tailing storage facility, and we do have the space on our privately owned patented land package to incorporate this. In terms of water, we're committed to being more efficient with water consumption, and this year we are investing in our tailings thickeners to improve recycling capabilities with water. We've also invested in many projects that will reduce evaporation at our mine site. And in addition, PV4 will mean increased mining rates that would translate into more job opportunities for the surrounding communities as well.
Darren, there's a lot of property surrounding the Pinto Valley mine, and it's owned by the majors, BHP, Freeport, and also KGHM. What are your plans? Do you have any plans on increasing your footprint there or in consolidation or consolidating some of this property?
Well, that's a great question. And Pinto Valley is currently the only operating mine in this prolific copper mining district in Arizona, which has seen mining activity for over 150 years. And there are infrastructure synergies and resource growth opportunities with our neighbors, as you mentioned, that we are actively pursuing right now. And these synergies include, but not really limited to, the use of brownfield, private, patented, disturbed land and sourcing sustainable water for growth opportunities. Also, the use of underutilized copper cathode plants capacity and other valuable infrastructure to grow our production. And as well, there's addition of large-scale open pitable resource, copper resource growth that could add a second mine to our existing operation. So lots of opportunities, lots of synergies, and we're the only ones with mining infrastructure that's operating in the entire district.
Darren, that's a great overview of Pinto Valley. Now let's touch on your second producing mine, which is Cozamin, and that's in Mexico, and it produces approximately 50 million pounds of copper annually. Why don't you just provide us an overview of Cozamin?
Sure. Our 2021 copper guidance for Cozamin is approximately, as you mentioned, 50 million pounds of copper at a C1 cost of $1.08 per pound. Earlier this year, we announced a 10-year mine plan, and that's the strongest mine plan Cozamin has ever seen since it started production in 2006. From 2007 to 2020, Cozamin has delivered over $500 million in cumulative free cash flow, with positive free cash flow in each and every year of those years since we began production. And we expect even stronger performance moving forward with higher throughput rates and grades, leading to a 50% increase in copper production at first quartile cash costs, driven by several improvements at the operating level. Firstly, late last year, we completed a one-way haulage loop that has significantly improved our ore haulage efficiencies in the mine. Our mine plan now is calling for 3,780 tons per day, and we now have underground infrastructure for 6,000 tons per day when you factor in our 2,000 ton a day existing shaft and the ramp that we just completed. Our mill currently can achieve 4,300 tons per day, and this can be increased at low capex investment. And this presents an opportunity to look for ways to increase production. Earlier this year, we announced a project called Impact 23, and that we will release in 2023 to target increased production driven by innovation and optimization and fueled by resource to reserve conversion and ongoing exploration. In February, we closed a $150 million silver stream with Wheaton Precious Metals for half of Cozamin's silver. We believe Wheaton shares with our view that there are significant exploration and resource conversion potential that still exists and that would add to our already current 10-year reserve mine plan. We decided to sell half of Cozamin's silver because it was the lowest cost of capital that we could use to eliminate all of our debt position at Capstone. And we have one of the strongest balance sheets now in the copper industry with a cash position at the end of last quarter of 75 million. And at current copper prices, we're delivering an after-tax operating cash flow around $30 million per month. So we are cashing up as we continue to de-risk Santo Domingo and prepare to deliver transformational growth with that asset coming online.
So Darren, you just mentioned that one of the reasons why Wheaton got or did the royalty agreement with you was because of the exploration upside. Can you just expand on that? What are your plans for exploration at Cozamin?
Yeah, well, we have two main vein systems there, and they're both open both to depth and along strike and up dip. So they're open in all directions, and we plan to do an aggressive exploration program over 2021 and 22 to add to the exploration success that we've already achieved there. That's number one. And the second prong to that is there's a fair amount of inferred resources that we will do the appropriate amount of engineering to turn that resource into a reserve as well. So both two bumps, one in exploration success and one in resource conversion to reserve.
Great. So we touched on Pinto Valley in Arizona. We touched on Cozamin in Mexico. Let's go to Chile now and look at your development project there, which is called Santo Domingo.
Sure. So in Santo Domingo, we've now owned this project for just over 10 years. So you don't always get the timing right when you buy assets, but if you buy a very good quality asset located in a very good jurisdiction, you know there'll be a time that the market is right to put it in production. We believe that time is now. As I mentioned, we were attracted by this asset because of its location in a very well-established mining district at low altitude, close to port, with great local community support. And these attributes lead to lower risk, as you would expect when you're trying to execute, either permit or build a copper project. Notable mines in the district include Lundin Mining's Candelaria mine to the south, Codelco's El Salvador mine to the east, and Orion Mitsubishi's Manto Verde mine just to the west of us. The project's estimated capex is 1.5 billion, and that includes a $250 million port and $150 million iron concentrate pipeline. In March, we announced that we entered into a binding agreement with a port builder and operator for Santo Domingo, and now we're also in discussions to replace the pipeline, the iron pipeline, with rail. So the mine capex with those two things in place have come down to approximately 1.1 billion. Also in March, we announced a $290 million gold stream, also with Wheaton Precious Metals, and that reduced the capex down to about 820 million. Factoring the expected project debt financing of 50% of the original 1.1 billion, then the remaining balance is now down to around $270 million in terms of equity contributions. And as I noted earlier, we are in partnership discussions right now to bring our ownership down from 100%, which we currently own, down to somewhere between 50 and 70%. And with this, our equity contribution could be anywhere from 0 to 200 million, which Capstone at these copper prices could comfortably finance. The two biggest advantages the Santo Domingo offers in terms of risk mitigation are first and foremost, the first 2 years are extremely high grade with copper grades over 1% copper equivalent. And this is really extraordinary for an open pit mine. And secondly, we have a fixed cost turnkey proposal for 60% of the mine site capex. And this should limit the impact of higher capex inflation in a time when we're obviously in an inflationary period with all commodities going up. So assuming prices of $3 copper and $8 iron FOB Chile, we expect a 1.9-year payback, so less than 2-year payback on capital and an internal rate of return of 33%. So it's an extremely robust project in terms of economics. The copper concentrate and iron concentrate, or magnetite, are expected to sell at a premium, and they're currently unencumbered of any offtake agreements, which is a key advantage for Capstone at this time. I'm also very excited about Santo Domingo's cobalt upside. We announced in March that we have moved our cobalt project to pre-feasibility study, with the feasibility study expected in late 2022. We're targeting a simple flow sheet with a number of off-the-shelf metallurgical steps to recover up to 80% of the cobalt in run-of-mine ore. Santo Domingo has the potential of being one of the top 3 global producers of battery-grade cobalt sulfate and the lowest cost of negative $4 per pound net of byproducts of sulfuric acid production.
So Darren, that was a great overview. I just want to touch on a couple of things that you mentioned. First of all, you said it was low altitude. What is the elevation?
Jim, it's just under 1,000 meters above sea level.
And then remind me again, how close is it to the water?
We're just under 100 kilometers from the water and from our port. And the port is fully permitted. Our project is fully permitted. As I mentioned, all the right-of-ways to get to the port are all permitted as well. So from start to finish, we are permitted throughout the from site to the port.
And because it's low elevation, like you said, 1,000 meters, there's many mines in Chile that are at 10, 12, 15,000 feet in elevation. It's very complicated to construct. It's very complicated to get labor there and also water. Why don't you just touch on that and what these factors mean for Santo Domingo?
Yeah, well, that's a great question. One of the main reasons why we like Santo Domingo in the first place and we bought the project is because it was at low elevation. We looked and we saw that all of the projects that were really big blowouts on capital a lot of them were due to high elevation, because you get much less productivity and a much harder engineering accuracy when you're trying to define capex from an engineering point of view to actual. And so we just felt that low elevation, you get increased productivity, less technical risk from a low altitude project, and we're very fortunate to have this project, one being at low altitude and two being in the third region in Chile, which is the Atacama Deserts.
Also, because of where it's located, labor is also not an issue.
The only employment anywhere around the asset is all mining. As I mentioned, all those different mines in the area, as well as mining projects, with no agriculture. So there's no other employment opportunities really to speak of other than mining. And so that's why we've had such strong community support to build this mine and get into production to get employment increased in the district.
Darren, I'm curious, you mentioned on the outset that the CapEx is 1.5 billion and you're looking for a partner to reduce your exposure there and also reduce your capital commitment. But given that copper is at all-time highs, why not just build this yourself?
Well, we'd like to bring in, say, a 20 to 30% partner that would be interested in a copper offtake. We believe that the types of partners that are interested in offtake allow very attractive financing rates. Their cost of capital would be lower in places like Asia than it is here. So we're interested in keeping a very conservative balance sheet, having a minority partner that allows a low cost of capital, and it allows the companies like Capstone to keep an extremely strong balance sheet and to fund all the other growth opportunities we have going on at Cozamin and Pinto Valley at the same time that we build Santo Domingo.
So Darren, one of your largest shareholders was Korea Resources Corp, also known as KORES, and they recently sold their position in Capstone Mining. So why don't you just touch on that, why they sold, but also I want you to tell us a little bit about how easy it was to place that block.
Sure. Well, as you mentioned, Jimmy, Chorus was a large shareholder, and they had been in Capstone for over 10 years. And as well, they were the 30% partner in Santo Domingo. But their global mining strategy changed with a new government, and they've been mandated to sell all their mining investments. So earlier this year, we announced that we agreed to buy Chorus's 30% stake in Santo Domingo in late May. So we acquired back the 100% interest. And then, as you mentioned, just recently, Chorus sold their approximately 40 million shares of Capstone, and that went to over 20 institutional investors in about 20 minutes of live sale. And mostly generalists and resource investors in the U.S. and Canada, where we've been advised who bought the shares. But of note, our largest shareholder, GRM, added 10 million shares to their holdings, and they were one of the biggest buyers of those Chorus shares. And with that, they currently own just under 25% of Capstone. And they remain very bullish on Capstone, on our strategy, as well as the overall copper fundamentals. And so they're very supportive of Capstone and our growth plan.
Darren, you just mentioned that some of the buyers of the block were U.S. investors, and I'm surprised to see that you don't have a U.S. listing. Is this something you might be pursuing in the future?
We are looking into a U.S. listing. We believe we're getting more and more U.S. investors, and as copper becomes what we believe is going to be the new red gold, we believe that the U.S. has mandated energy policies and increased power policies is going to drive more investors into copper, and we would like to expose them to that through a listing and Capstone. So we are exploring that as we speak.
Darren, in the next few minutes, why don't we just wrap up with what investors can expect just in terms of news flow in the coming weeks and months?
Sure. So really what's in store for Capstone moving ahead? Well, clearly the largest catalyst for Capstone this year is, most important, as we just spent some time talking about, is getting Santo Domingo under construction sometime in the second half of this year. And also, we believe that we can put together some good news on this district consolidation at Pinto Valley. We think we can get some of that done by the end of this year as well. In 2022, we'll announce the results of our PV4 study that will show Pinto Valley's true potential, and the cobalt feasibility study at Santo Domingo, which, as I mentioned, it will be one of the largest and lowest cost cobalt projects outside of the DRC. And then in 2023, our Impact 23 study at Cozamin will be released, and that'll show the true potential of Cozamin as well. And all this leads into transformational year of 2024, where Capstone more than doubles production from today's level and goes up to 200,000 tons of annual copper production per year, with C1 costs below $1.20 per pound. So, Jimmy, we've got an exciting future in front of us, and I think we're one of the most attractive vehicles for investors looking for exposure to copper and soon to be cobalt.
Darren, that was a great overview of the Capstone mining story, and I want to thank you. But before I let you go, I got to ask you about that photograph in the backdrop.
This photograph's great. It's a Canadian artist that does photography, and this is the actual mine that the original statue of David was mined from, and mining still goes on to this day. So it's a phenomenal picture, and I'm happy to have it. Thank you for asking.
Well, Darren, once again, I want to thank you. And to all the viewers, if you have any questions that were not asked or answered during this discussion, please send us an email to info@bloorstreetcapital.com, and we'll make sure someone at the Capstone Mining team reaches out. If you would like some research on Capstone Mining, also send us an email and I'll send that along. Once again, Darren, thank you.
Thanks very much for having us, Jimmy, and appreciate the time.
Tony, thank you very much for joining us today.
Jimmy, glad to be here and looking forward to our discussion.
Tony, the Trilogy Metals story is unique in many ways. First of all, it's in Alaska, it's a VMS deposit, it's high grade, and you have a very interesting shareholder base. And I want to touch on all of those elements throughout this discussion, but maybe you can just start with a brief overview of Trilogy Metals.
Sure, that's a really good summary as well, Jimmy. So Trilogy Metals was created as a public company in 2012. It was spun out of Nova Gold, and our principal asset is a joint venture in the Ambler Mining District. And basically last year, 2020, was a really big year for us. We entered into a JV with our partner South 32. They funded $145 million into the JV. We got an important permit for the road. We released the feasibility study on advanced development project called Arctic. So it's been, a lot of stuff has been happening in the last year. And with metal prices going our way, we're looking forward to the next steps, which I would say the most pressing or important factor for us is really going to be our drill campaign this year, where we're going to be drilling 14,600 meters. So the key points with respect to Trilogy in the Ambler Mining District, we're in Alaska, as you pointed out. It's high grade. It's a high grade deposit as far as Arctic, 4.2% copper equivalent, 43.4 million tons. That's a fairly sizable VMS deposit. We have other exciting development projects within the pipeline, including bornite and advanced exploration opportunities in the district. And then lastly, we're well funded, and we'll talk a little bit more about the partnerships as well.
And Tony, why don't we just talk about the economics associated with Arctic and also just give us a little bit of background. You already mentioned the grade is 4.2% copper equivalent, but just talk about the size. If and when this thing does go into production, how many millions of pounds would it produce a year?
Yeah, I think it's going to be a when it goes into production. And right now, Arctic is about a 12-year mine life, and it depends on how you look at the deposit. As you mentioned, it's a VMS deposit, which basically means that it's going to be producing copper, zinc, gold, silver, and lead. So if you look at it as copper equivalent production, it's about 270 million pounds a year, converting the other metals into copper. If you take the other metals and apply them against the cost, it's about 155 million pounds of copper a year. And I think the big key point for us is really about extending mine life as much as possible. And what we're trying to do is, right now we have a 12-year mine life, and we're looking for opportunities through our exploration program to extend that considerably. And maybe on economics, I'll just touch a little bit on how the economics play out. When we ran our feasibility study in 2020, we used the same prices that we had used in our PFS from 2018. So we used $3 copper, $1 a pound lead, $1.10 for zinc, and gold was at $1,300. Silver was at $18, and we came up with a $1.1 billion after-tax NPV with a 27% IRR, with cash costs on a copper equivalent basis, with credits for those other metals of about 28 cents. Today, with metal prices being considerably higher, that NPV is now $2.6 billion NPV on an after-tax basis, 45% IRR, and the cash cost on converting the other metals is actually negative 28 cents now. So this is a really robust project for what we have today. And as I said, we're really focused on the exploration potential in the district.
Tony, the Trilogy story is one based on relationships and partnerships. And why don't we go through these partnerships right now, starting with the state of Alaska?
Sure. The state of Alaska, I think the first thing that the state of Alaska has done is really created a positive environment for us to invest in. And they've been very supportive at all levels of government within the state. We've had tremendous support. The biggest partnership we have with the state is through an agency called ADA. And ADA is really a development arm of the government. And they were instrumental in seeing the largest zinc mine in the world get built, because they helped build the road that connected Red Dog to the port, and they also built the port. So ADA effectively funded the development of the port and the road at Red Dog. And we're looking at a very similar model for the development of the Ambler Mining District. And I mentioned earlier that we got a key permit for the development of a road last year. Well, ADA actually got that from the BLM, and that was the final permit that was required to allow the road to advance. So we're in the process now of moving forward with detailed engineering. We agreed earlier this year to a co-funding arrangement with ADA, where each party would fund $35 million each, so $70 million in total, to be spent over roughly the next 3 years. And the idea is to use that for detailed engineering to advance a project. And then the next key steps would be to enter into a tolling agreement with ADA, which would provide for tolls for our use of the road while the project is producing copper, and also to obviously commence the construction and financing, which we would expect to start after the permitting of a mine has been completed.
So you have the support of the governor and also the senators of Alaska?
They've been very supportive at all levels. Governor, the 2 senators and the congressman have been 100% supportive of the project, and they recognize that this is really a district that has a potential to not just have one mine, but many mines in the district, which will create benefits, not just obviously for Trilogy and South 32, but for our other partner in the district, which is NANA, the Native Corporation, which we entered into a partnership back in 2012. So they will either be a co-owner of any of the mines that are developed, or they'll get a net proceeds interest, similar to the arrangements that they have with the Red Dog mine. So having revenue being generated going directly to the Native Corporation and the shareholders of NANA, which are 14,000 residents in the district, is extremely important. So we think all of those play well at the state level, the federal level, and obviously with NANA and the communities surrounding the Ambler Mining District.
So Tony, you brought up a good point. The environment is so important now, and there's another large-scale project in Alaska that's gotten a lot of pushback from various groups. Can you just tell us how Trilogy Metals is different from that other project?
I think the biggest impact is we don't have any fish. There's no commercial fishery lobby that is against the project. We've got a native partner being NANA and the Northwest Arctic Bureau. We're working very closely with them. They benefit directly. We've got the support of the state government, the 2 senators and congressmen at the federal level. So we feel we have a lot of government and state support. Those are the big factors. And then I would also say the footprint of our operation is actually very small. And that's another key determining factor. It's not like this other project that you've mentioned, which had an enormous footprint. And there was real concerns about the impact on waterways and watersheds. And we just don't have those same issues given the size and scale of our operation.
So we touched on the government, we touched on the Native Corp. Why don't we look at your shareholder base now, because you have a very interesting shareholder base. Electrum is a large shareholder at 20%. Paulson is a very large shareholder, just under 10%. Baupost, and also Neuberger. And another shareholder is South 32. A lot of people are not familiar with South 32, or a lot of people in North America aren't. So why don't you give us a little bit of background on South 32?
Sure, and maybe I'll just comment on those first shareholders before I do that. So Paulson, Baupost, and Electrum all received their shares on the spin-out of what was previously called Nova Gold Trilogy, Nova Copper, excuse me, Trilogy, which occurred in 2012. And then Neuberger bought in the open market. Those shares are now owned by an individual called Bernard Sell. So those are the large shareholders. And together they control somewhere around 46, 47%. If you include management in the mix, we're about 50% of the company in total with those large shareholders. And South 32 acquired their stake, roughly 11.2%, through financings that we did a few years ago and through open market purchases. So South 32, large Australian mining company, they were spun out of BHP. They've done very, very well. They operate around the world. They're interestingly transitioning from other metals into base metals, and your listeners and viewers can go to their website, and there's a presentation that they just put out where they're talking about their strategy with their focus on green metals and base metals in particular. They did a very large acquisition in the US of a company called Arizona Mining a few years ago. It was a large zinc project called Hermosa. They paid roughly $1.3 billion US. The chairman of the president of Arizona Mining, his name is Jim Gowans. He actually sits on our board now. And Jim isn't there because he was the chairman of Arizona Mining. He's there because he was involved in the construction of Red Dog. And so he has a long history with Alaska. The fact that he dealt with South 32 when South 32 acquired Arizona Mining is just a bonus. So we've got a great relationship with South 32. We're 50-50 partners at the JV. We work very closely together. We both have the same objective, which is to create value for our shareholders. South 32 in total has invested about $200 million in the Ambler Mining District in Trilogy, $145 million to set up a JV, $30 million in exploration funding, which occurred over a 3-year period, and then acquiring their 11.2% stake in the market through financing. So they're committed just like we are. And like I said, they're a great partner.
And Tony, when South 32 first made the investment in Trilogy Metals, did they care more on Arctic or Bornite?
Yeah, so we haven't talked about Bornite. Bornite is our advanced exploration project. It's a large copper deposit, roughly 180 million tons, grading 1.6% on average between the open pit and the underground. And what's interesting is that South 32 came knocking on the door originally in 2016, maybe it was 15, and they were interested in forming some sort of partnership with Trilogy to look at the district. And the offer that was on the table wasn't compelling enough for us. And we basically said, thanks, but no thanks. They came back with a second offer, which was that they would invest $30 million in exploration over a 3-year time period, giving them the option to form a JV on the Ambler Mining District if they put in $145 million. So that's what we agreed to. And that $30 million that they spent was all spent on Bornite. So there was really no focus on the Arctic project at the time. Their interest was really in the Bornite deposit. So we had some great success at Bornite, but at the same time, Trilogy was continuing to look at Arctic from a PFS perspective, and we came out with very compelling economics on the PFS, and that's really what changed the focus for everyone from Bornite to Arctic. So the focus is on Arctic right now, and the economics that I gave you are on Arctic. But what's interesting is a real reason why South 32 came into the project originally was Bornite, and Bornite's still there, and Bornite still has tremendous, tremendous option value and upside associated with it.
So a couple of things I want to highlight here. First of all, you already mentioned South 32 has no exposure to base metals, i.e. copper and zinc, except they just bought that zinc asset. Was it Arizona Mining? Was that the name of the company?
Yeah, it's Arizona Mining, yeah.
Yeah, and they have no exposure to copper outside of their investment in Trilogy Metals. Is that correct?
Yeah.
So what do you think they ultimately want to do here?
I think South 32 has stated very clearly that they want to have more exposure to base metals and green metals. And as I said, I encourage your listeners, viewers to go to their website and have a look at the presentation. They've got this great slide. They've got the usual pie chart slide of all the metals that they're interested in, and they have copper listed there. And the only projects that they have copper exposure to are the Arctic project and the Ambler Mining District. So, whether they're happy owning 50% of the district as it stands today and 11.2% of Trilogy, or whether they want to own more, hard to say. But I would say they're very supportive of being in the district and exploration. The other thing, Jimmy, that's really interesting is that they just highlighted recently that they've staked additional ground outside of our area of interest, an area that they call Roosevelt. And they conducted some exploration last year. They're going to have people on the ground conducting geochem and other testing this year with a view to ultimately drilling that area. So what it says to us is it says that they're interested in the district potential as a whole and the quality of opportunities that are in the district. And the area that they've staked is also close to the road. So it's great in that you could have another party that could potentially pay for the tolling costs associated with the road.
Yeah, I guess one of the things that really comes to my mind is that South 32 is a very large company. They would have no troubles buying Trilogy Metals. And I just wonder why they didn't do it last year when copper was at 225 or even 250. And now copper is near all-time highs. and they're kind of in a position now where they can't do much unless they really pay up for an asset. It doesn't matter if it's Trilogy Metals or what it is. And
I think that's a very good summary of a situation. I think what happens is for companies, for large major mining companies, and you know, in my previous life, I was a CFO of Kinross. We had the Fort Knox mine in Alaska, and I can tell you, we spent a lot of time thinking about strategy and assets and investments. And companies often look at option value, and that's a way South 32 has approached its investments in Trilogy. They came in, they put $30 million on the table, which was exploration. That gave them the option to form a JV. They put in another $145 million in to form a JV. They're still thinking about how Arctic moves along from a permitting point of view and the road. They want to see, hopefully, the deposit be longer mine life. They want to see the district potential. And they're taking baby steps in terms of doing it. But when people put those or take those steps and they look at those option calculations, they often do it in a fixed commodity price environment. In other words, they run $2.50, $3 copper. They don't assume that the copper price is going to go to $4 or $4.50 or $5 or $6, because then you know, it would be too easy for them to say, yes, of course we should put our foot on it. So they're always using that constant price. So in this case, the benefit that we've had is we've got $145 million in the JV. And what we want to do is we want to spend that, Jimmy. We want to spend it. We want to spend it on the district. We want to create exploration potential, and we want to demonstrate the exploration potential in the district. So we didn't have a field program last year. We're going to conduct 14,600 meters of drilling. We expect to have some good results. We're looking at some areas outside of areas that we've tested before. I think there's a lot of upside in the district. And, you know, we hope we have lots of success. And I know that South 32 wants us to have lots of success because they've committed a lot of capital to this. So whatever the end game is, our main focus is to add value through the drill bit right now and use that $145 million wisely to advance not just Arctic, but the district as a whole.
so, Tony, you talked about exploration here. So why don't we dive into that? Because like you mentioned earlier, you didn't do any drilling last year because of the pandemic, but this year you're going to spend $27 million. Can you give us a breakdown how much of that is going to be applied to Arctic, if you're going to do any drilling on Bornite, or what exactly are the satellite deposits where you want to do drilling?
We're going to drill 7,600 meters at the Arctic deposit, and then we're going to have additional drill programs within 3 to 5 kilometers of Arctic. And then we're going to look at the district potential. So we've got some areas which are called Sunshine and a couple of other areas in the northern part of the district that are also EM anomalies, which are further from Arctic than the 3 to 5 kilometers. So we're going to drill those. And then what I'm really interested in is an area between Arctic and Bornite. So this is an area that the distance is about 20 kilometers. There's a drill hole in there that's called Nana 1. It was drilled by Nana in the 1970s, and it hit mineralization. We don't have any of the core, so we're interested in looking at that. We brought in a fellow that I used to work with at Ivanhoe. His name's Dr. David Broughton, and Dr. Broughton, his focus was in African copper belt discoveries, and Bornite has lots of similarities. So when we're looking at this hole between Arctic and Bornite, it's really on the recommendation of David and Richard Goss, our VP Exploration, and we're looking at 2 other holes adjacent to Bornite if we have time to drill them this year. So that's what we're really, you know, interested in, because we haven't drilled in these areas in a long time. And like I said, we're getting 0 value in the share price right now for Bornite. So we're really excited about those holes.
That's a good segue to my next question, and that has to do with valuation of Trilogy Metals. Copper is making all-time highs, but Trilogy really hasn't responded the way I would think it would. Can you just touch on that, please?
Yeah, I think there's a couple of factors there, Jimmy, and it goes back a little bit to last year. We didn't have a drill program last year, so we certainly trailed in terms of performance in the latter part of a year, especially. There was also a large seller that was out there liquidating their position because of redemption point state. So that sort of overhung the market for a while, and that got cleaned up towards the end of November. And since then, we've done much better. Then I think the last point is that people that want copper exposure have sort of gone to the copper producer names initially, and we're starting to see people look at the explorer names in a big way. And you're right, we haven't performed as well as the copper producers, but we're starting to definitely move, and we traded our 52-week highs recently. I purchased 200,000 shares last year in the open market in November as part of a cleanup trade. That was at about $1.45 US. I recently just exercised 150,000 options as well, and I'm holding those and going to continue to hold those positions. I think we're in a really good position in terms of share price. I think there's a lot of upside on the share price in the fact, given that we're going to have a very significant drill campaign this year. And when I look at some of the other VMS stories out there and copper stories, I see how well they've reacted when they've come out with drill results. And we're going to have probably not, if not the largest, one of the largest drill campaigns we've had in the Ambler mining district this summer. So we expect big things once our drill results start to come out in the fall, likely starting in September.
Tony, that's a great overview. And as we wrap up here, why don't you just tell investors what they can expect in terms of news flow in the next few weeks, in the next couple of months?
Yeah, as I said, I think the big difference from this year to last year is we're going to have lots of information coming out with respect to drill results. That's going to be towards the fall. The other big factor to keep an eye on is permitting. We plan to start the permitting process for the mine later this summer, so we should have some information on that. The study work, the feasibility study work that Trilogy did, we've handed that over to Ambler Metals, which is a JV. They're continuing to move that forward, so we'll have information on that. And I suspect there'll be more updates in terms of how the road is progressing and how things are moving forward on that front. We're thinking about bornite and how bornite fits into the longer term district potential. And that's something that hopefully at some point we'll be able to talk a little bit more about in terms of what our thoughts are. So those are going to be the big factors, but I'd say there'll be some good news flow coming out. As I said, we're in a really unique position that we've got a high grade development asset in Arctic. We've got a high grade exploration project in bornite. We've got a lot of cash on the balance sheet at the JV level, and we're in a very safe jurisdiction that's very supportive of this project moving forward.
Tony, that's a great overview of the Trilogy Metals story, and I want to thank you for sharing it with us today. If any of our viewers have any questions for Trilogy, please send us an email to info@bloorstreetcapital.com, and we'll make sure you get a response to your questions. Or if anybody would like some research on Trilogy Metals, send us an email and we'll send that along. Tony, once again, I want to thank you.
Jimmy, thank you, and thanks to Bloor Street Capital for your support. Look forward to providing you with future updates. Thanks again.
Paul, thanks for joining us today. It's good to see you again.
It's great to see you again as well, Jimmy.
Paul, Rio Tinto recently made a strategic investment in Western Copper and Gold, but before we dive into that arrangement, why don't you just start by giving us a brief overview of Western Copper and Gold and the Casino project?
So Western Copper and Gold has one asset, which is the Casino Copper Gold project. Large copper gold porphyry up in the Yukon, 21 million ounces of gold, 11 billion pounds of copper. We've been developing the project for about 12 years. We have a full feasibility study we did in 2013. We're part of the way through permitting. And excitingly, we've got a PEA, which will update that feasibility study coming out for the end of June. And so we're pretty excited about that. And of course, the big news is the investment by Rio.
And Paul, one of the knocks you always hear about the Casino project is the grade. So let's touch on that. And then in relation to the grade, the strip ratio and how important that is.
Sure. Yeah. I mean, everyone, and I spend a lot of time talking about grade, and I'm happy to talk about it because it's something that people have a quick look at this resource and it's huge, sheer pole, but it's low grade. And I'm like, okay, it is because everything is ore. And the way to think of this, if you look at the core of the deposit, first of all, the core is 330 million tons. This is a good size copper and gold project just with that. 330 million tons at 0.7 copper equivalent. And then that is surrounded by 3 billion tons of lower grade ore. So when you look at, and this will come out in the PEA, if you look at the first 4 or 5 years, it's all 0.7. And then the grade drops as you get out of that core zone. But everything's paid back in that first 3 or 4 years. And that's very, very important. And the other key component of this project, and really, I always say there's two things that makes this project add up as well as it does. One is that early high grade, that 0.7, that core. Second is the strip ratio. On our old feasibility study, the strip ratio was 0.59 to 1. We did a bunch of infill drilling a couple of years ago. That's going to come down. We'll see what that looks like when the PEA comes out, but I think it's pretty safe to say it'll be less than 0.5, at least for the first 25 years. But it's so big now, it's almost a 50-year mine life.
And just to reinforce the importance of the strip at 0.5, it just means there's less material to move, which means better economics, higher margins.
Yeah, I mean, these big projects like this, I mean, they're big earth moving exercises. The less earth you need to move, the less rock you need to move, the more economic that they are. And so I think that I literally do not know another project that has a lower strip ratio. Every ton that you move is close to $2 a ton in terms of moving, mining and moving that rock. And so if your waste to ore ratio is 0.5 or less, that's just a lot less material that you're going to move. It goes directly to the bottom line, goes directly to the good economics of the project.
And Paul, I'm sorry, did you mention the mine life?
Yeah, I mean, so last year we issued a new resource, and so the measured and indicated is now up to around 2.2 billion tons. So in this PEA, the PEA is actually going to have two cases. The first case is, let's call it nominally the billion-ton case. Goes into one tailings facility, and this is a tailings facility that we've done a bunch of work with the community, the regulator, the First Nations, so everyone's relatively comfortable with that tailings facility. That's sort of phase one. In the PEA, we also look at sort of phase two, which is the full 2.2 billion tons. I think, I'm starting to see some of that come through. I think it's 47-year mine life, but it's not quite done yet. And that's just the measured and indicated. If you bring in the inferred, you've got another 25 years. So you've already got at Casino around 75 years worth of ore identified. And there's lots of upside. I mean, we're doing some exploration this summer as well. So, it's a big project, starts off really nice, high grade, low strip ratio throughout. Very, very simple project to execute. And a great copper gold project.
And when you talk to the majors, it doesn't matter if it's Rio, BHP, or whoever it is, this is what they're looking for. Long mine life, 50 plus years.
Yeah. I mean, this is, as we've always been packaging this up to bring in, a strategic investor, a partner, whatever that business transaction looked like, that was going to be someone like a Rio or a big gold company. And, I think we've talked in the past about that. And, certainly have been very close to doing some deals in the past. This deal with Rio, it took us about 18 months to get a deal done, but we're really happy with the deal and the way it's structured. We think it's a great deal for Western and their shareholders and our shareholders, and it's a great deal for Rio as well.
So before we do a deep dive on this Rio deal, why don't we just touch on the support you've gotten from the Yukon government and also from First Nations? Yeah,
I mean, the Yukon is a very mining friendly jurisdiction, and I like to think of the Yukon, and 4 years ago I used to say, the Yukon it's an emerging mining jurisdiction. It's going to be a really exciting place to be. Now I look at it, it's already there. You've got 3 operating mines. You've got Victoria Gold's Eagle Mine, you've got Alexco Resources and their Keno mine, and Pembridge Resources and Minto. So there's 3 operating mines. Obviously, our project is a large project moving forward. Our next door neighbors with Newmont and the Coffee Project is moving forward. So there's lots of activity up in the Yukon in terms of mining projects or mines in operation and moving forward. And the Yukon government has been very, very supportive. You know, we work with them as part of the Yukon Mining Alliance. You know, they provide funding for us to do marketing around the world. I'm actually the chair of the Yukon Mining Alliance right now, and it's been great. And we get the premier, we get the minister that comes to things like the Denver Gold Show and talks to investors, and it's really helped push the Yukon into, you know, people's minds again as this mining destination, not emerging mining just destination that's here now, and it's just going to continue to grow.
No, you're right. The Yukon Mining Alliance has done a great job, and I'm glad you brought that up. I didn't realize you were the chair, but they always hold a big Yukon site visit every year. Are they going to do that this year?
Well, it's funny because, I mean, like everyone, we've been sort of doing the COVID dance a little bit to see if it was going to be in person or not. I think it was going to be in person till about a month ago, and we just looked at the timelines and said, it's not really going to happen this year. So we'll do some more. Last year we did. It was great, actually. We had a film crew that came up, went to every site, did a really great job. I think we're going to add to that this year and talk maybe even a bit more about the Yukon and some of the infrastructure that's there, and you know, some of the other sort of less, you know, not just mines, but everything else that goes into making a mine and a jurisdiction successful. And so we're going to add to that this year. But I'm pretty confident 2022 will definitely be bringing people up to see everything that's going on.
That's great. I look forward to that. So why don't we dive into the Rio Tinto deal? One of the things I was really surprised about, Paul, was the fact that it took Rio Tinto 18 months to make a $25 million investment. And I guess one of the reasons why I'm surprised is because they've spent billions of dollars on their mine in Mongolia. I can't pronounce the name of it, so I'm not even going to try. They've spent billions of dollars. They've had lots of issues with the Mongolian government, and yet they continue to push ahead with that underground expansion. But yet this small investment in one of the greatest mining jurisdictions in the world took them so long. Why did it take so long?
Yeah, I mean, it's and I'll just walk through the 18 months because, you know, if you just go 18 months, it's like, why did it take so long? But, you know, that's from signing the first CA to announcing the deal, that 18-month timeline. So it's worth breaking it apart a little bit more. So first of all, you know, we signed a confidentiality agreement with them in November of 2019. And for the first, I would say, you know, 8-9 months, they just did diligence. I mean, we had a data room, they asked us some questions. And so it wasn't until last summer that we started to talk about, you know, what sort of deal do we want to do? And so we, you know, bounced around a few different things and ended up with where we are now, which is the idea of this strategic investment. So, you know, the nucleus and let's say the initial term sheet was, you know, sort of finalized in November of last year. So just as a sort of proposal, and it's like, okay, I think we can work with that. So it's really been since that November timeline. So about 6 months, and, you know, keep in mind we had Christmas in the middle of that as well. So yeah, and it's, you know, there's lots of back and forth. The other thing, I mean, Rio is a big organization, and, you know, certainly I think you've got to be patient with when you're dealing with them. They need to get different departments to sign off on different bits and pieces, and so there's lots of those sort of things. But, you know, I think from, you know, right at that November, we had it roughed out and we knew we wanted to do something, and so happy that we finally got it over the finish line here.
And so once again, they made an investment of 25.6 million or 8%.
Yeah. So, and so I'll walk through a little bit of the terms. So I mean, they made the investment $25 million to get 8%, and, you know, with that comes what's called an investor rights agreement. And actually, I think the investor rights agreement is going to be on CEDAR. So if anyone wants to pick through the details, they can pick through the details. But really, you know, at a high level, what's in this investor rights agreement is a couple things. So first of all, it's really, there's a bunch of things that just ensures that, you know, we as Western and Rio work together over the next 12 months or so to really help them understand the project better. So there's a scope of work which we've agreed to, which is some additional drilling, some additional geotechnical work, some additional metallurgical work, some relogging of core, some work, in terms of dealing with First Nations, the regulatory process, understanding all that. So that, and then associated with that is the right for Rio to second people into Western. There's a technical committee that oversees all that. And so that's really the core of the agreement. And so we've been very, very active on this. Rio's already got people up at site, and we opened up site, and so we're putting that all together. We sort of started to work on that in parallel, just planning for success on the deal. So that's really the core of the deal and of the investor rights agreement. And then in addition to that, there's what I would say to a certain extent boilerplate type clauses around restriction on them selling shares and or buying shares for 12 months, and then they have a right to put an observer onto the board, and if they get to 12.5%, they can actually bring in a board member, and then some other rights in terms of placement of shares. And this is sort of if things don't work out, then we can place their shares and make sure that they go into good hands. But I don't think we didn't spend all this time negotiating this to plan on it not being successful. So I certainly feel pretty confident that it will be successful.
And why didn't they make a larger investment, 9.9% or 19.9%?
Yeah, I mean we were specific on that. We sort of said, look, I look at those 19.9% investments, and I always look at them sort of a little bit cautiously, because once you give a company that amount of ownership of your company, they basically own you. I mean, they can control, with 20% of the outstanding shares, they can really control, what goes on with your company, and it scares off anybody else that might be interested in acquiring the assets. So we wanted to keep them less than 10%, and that's why they ended up at that 8%. And the other thing was the scope of work, and the scope of work that we've agreed to do with Rio runs. It's going to be probably maybe $10 to $15 million worth of work. So share prices are bouncing around and things like that, but it's sort of roughly in that ballpark.
And then did they give you strict guidelines on how the $25 million is going to be spent?
There's sort of an initial scope of work, and then there's this technical committee. And so the technical committee is 2 members from Western and 1 member from Rio. And then that technical committee really oversees how that money is going to be spent. So we roughly know what's going to be done, but the fine details really is at the discretion of this technical committee.
And there is an 18-month target on this agreement?
Yeah, so the technical committee, the secondment to the board, the secondment into the company, the observer on the board, all of that is in place for 18 months only. And there's a one-time ability to extend that by 12 months. So it could potentially go up to 2.5 years. But the idea here is that in 18 months, really, we're going to work with Rio to make sure they understand the project, and presuming that they do this sort of almost a second level of due diligence, then we talk about what the next business transaction is. Rio isn't spent all this time and effort to have 8% of the company that owns this asset. They've spent all this time to look at it with the idea that eventually one day it'll be part of the Rio Tinto stable.
Yeah, they just want to make sure the project meets their standards.
Yeah, I think that's a good way to look at it.
And when you said there is a one-time clause for them to add an additional 12 months onto this agreement, when is that? Can that happen at any point, or is there a specific date?
Yeah, it's, I think the idea with that, where the negotiation around that was, look, if at 18 months we still like what we're seeing, but we're not quite there yet, we'll add on the 12 months. And, so it seems, and I'll be honest, after the negotiations we had with them and the challenge of getting things through a big organization, I think it was pretty prudent to add on that 12-month extension.
And I'm curious now, if during this 18-month period, another major comes in, I'm just going to throw BHP just for argument's sake, comes in and they want to sign a confidentiality agreement. Are they allowed to do that? Or are you allowed to do that?
Absolutely. Yep. No, absolutely. And so, again, that's why we structured it less than 10%, is that if there is somebody else that's interested and wants to take a look, we can sign a confidentiality agreement. They can come in as an investor as well. There's no, Rio doesn't have a right of first refusal. They don't have a right of first offer or anything like that. It's just this, idea to work together for 18 months and help them understand, just dot all the I's and cross all the T's.
So in the past, you have said that BHP looked at Casino, but it was too small for them. What is it about Casino that attracted Rio Tinto?
Yeah, to be fair to BHP said that before we had the updated resource that we came out with last year. So I think that updated resource certainly helped open a few eyeballs just in terms of the size of it. And so I think that's absolutely key. Yeah, and we'll see if somebody comes out of the woodwork. We're pretty happy with Rio. I'll be honest, they've been a really good group to deal with. But yeah, if somebody wants to come and kick the tires and sign a CA, that's always available.
So let's talk about the valuation, Paul. Since the Rio agreement with Rio Tinto was announced, the stock is up 50%. Are you happy with that?
I'm always happy with this when the share price goes up, but yeah, it's been interesting because the day of announcement we were up about 25%, which was good, but I was like, well, this is a pretty big deal. Like I think it should be up a bit more, but I guess it took a little bit for the news to disseminate, because it was over the next sort of week after that the sort of other 25% sort of came, and now we're sitting up about 50%. But yeah, I think if I was on a call earlier with somebody and we were talking about valuations and then benchmarks, and if you look at some of the people in our peer group and where they're sitting at with similar type projects with similar economics, we're still a pretty good deal out there. Where our valuation, I think we're 400 million market cap right now, Canadian. So that's what, 300 million US with the project. And this will all come out with when the PEA comes out. But, the net present value is going to be billions, right? And at long-term commodity prices, and it's going to be billions and billions at spot. So we're, certainly, if you want to play that sort of P to NAV game, we're at the bottom end of that. And in the past, people go, yeah, but how are you going to come up with the capital? Well, now that we've got this deal with Rio, it's pretty easy to see the path in terms of how the capital is going to come into this project.
And Paul, since this investment was announced with Rio Tinto, have you had a lot of inbound calls from investors? And if so, are they from the US, Canada, or Europe?
Yeah, no, it's been busy. It's been we sort of had a number of things planned, and then all the different banks and a number of investors. A lot of interest out of the US. We've got a pretty good following in the US. We have that US listing, which makes trading obviously a lot easier in the US, and so a lot of interest out of the US, which we're always happy about. We've also got a pretty good following in Europe, so both in the UK and in Switzerland. So I've had a couple of calls with investors there as well. And I'd actually say Toronto is probably, and Canada is probably the market that we need to work more on. Certainly, we've got some great shareholders here in Canada, but not, I think, the broad following that we do in the US and Europe. So yeah, anyhow, it's maybe while we're talking to you, you can make sure this gets in the hands of some good Canadian investors.
Paul, as we wrap up, why don't you just tell us what's going to happen in the next few weeks and the next few months, and what shareholders can expect in terms of news flow?
Yeah, I mean the news flow that we see coming up over the next few months is probably the best set of news flow that we've had in a decade. I mean, obviously this Rio deal was big news, but you know we've got this PEA coming out before the end of June. We're going to be, you know, we're just finalizing the field season, the exploration, so we're going to be announcing that, and then of course results will be coming from that. You know, hopefully we get some early results by the end of the summer. We've got some really exciting stuff. I haven't talked much about the road, but you know, the government, you know, we worked really hard with the government, and the government agreed to build a big chunk of our access road. That's finally going to happen this summer. They're going to be turning over dirt. It's out for tender right now. So, you know, we're going to have some, you know, great shots of them actually building the access road into Casino. And we've got some met results that I haven't talked much about, but that look pretty good on the heap leach as well. So yeah, it's going to be lots of news coming up here, and pretty excited about it.
And I'm sorry, Paul, we didn't really touch on drilling, but are you going to do any drilling this summer?
Yeah, I mean, this is part of the scope of work that we agreed to with Rio. It's not tons of exploration, but there's a little bit of exploration in addition to, you know, almost more due diligence sort of drilling in terms of, you know, testing geological boundaries and things like that.
Well, that's great. That's a great overview of the Western Copper and Gold story, Paul, and a great update on the Rio Tinto investment. And I want to thank you very much for taking the time today. And for all of our viewers, if you have any questions that you would like to ask Paul or his team, please send us an email to info@bloorstreetcapital.com. Or if you would like some research on Western Copper and Gold, please send us an email and we'll send that along. Once again, Paul, thank you.
Thank you very much.
Hi, Cailey, and thank you for joining us.
Thanks very much, Jimmy. Pleasure to be here.
Cailey, I want to get your views on the current copper environment, and I also want to get your views on country risk and how it pertains to mining. But let's first start with the copper price. Copper got down to $2 a pound in March of 2020, and here we are more than a year later, and copper is trading at or near all-time highs. And I want to hear your views on if you think this price is sustainable and if it's being driven by speculation, or are you of the same mind as Goldman Sachs and you think this is the beginning of a new super cycle in commodities?
I'd love to subscribe to that. I don't, in all honesty, no, I don't think we're in a super cycle. I mean, and I should start with that because that's the caveat for not just copper, but for all commodities really. You know, if we turn back the clocks to when the last machinations of a super cycle were about us, that was, you know, pre-GFC in sort of 2006, 2008. You know, that was very much a demand pull from China, going from, you know, whatever it was, 10, 20% of global demand to 50. So that was a huge wave, and that drove the commodity prices up on the demand side of things. I don't see that this time, but what I do see is a structural change, and more in terms of this green element of it. You know, the economy becoming greener, the drive for electrification, for new technology. So it's, for me, it's a smaller push, but it's a push from sort of, let's say, the cost side of things as much as anything. You know, if carbon cost will come in, so the marginal cost of production is going to rise. So it doesn't. No, I don't think we're going to hit $5 a pound copper, but I do feel like we're not going back to $2.
Cailey, there are many undeveloped large-scale copper projects which have a very large capex to go with them. And we have the casino project in the Yukon has a capex of 2.5 billion. Taca Taca in Argentina has a capex of 3.5 billion. And Galore Creek in British Columbia has a capex of 5.5 billion. What copper price do you think we have to see before the majors move these projects forward to the construction process?
Well, these prices are incentive enough, but I think at the moment, you know, the consensus long-term copper price is around $2.90, $3 a pound, which is a fair enough level. It's been that for a while, you know. I think that's a sustainable level. The challenge will be, I guess, the opportunity will be is if consensus moves up to sort of 320, 330, that sort of level. That's probably enough. It's probably enough to incentivize the start of some of these bigger projects. But let's face it, the reality of the situation is right now is we don't necessarily need those projects right now. I mean, yes, of course, it's a long-term industry. Takes a long time to bring these projects through. We're not got the big major discoveries that we had of the last decades. So we do need new supply to come in, but we don't need it, you know, right today. And it feels like those sort of projects will take their time. They will come in as they're needed, and I don't have an issue with that. I don't think we need to rush to. This is the sins of the past, right, Jimmy? You know, this was as soon as the prices were high, let's push the button on a load of projects, and then the price gets killed. Investors lose money, money moves out of the sector, and everybody goes away shaking their heads. So it doesn't make sense for anybody. I just think the difference this time, which is just absolutely brilliant, is there's discipline, you know, and that's what we want to hear from companies making the right decision, balancing cash flow versus shareholder returns versus new project builds, and obviously exploration as well. And getting that balance right is absolutely key at the moment.
Cailey, I want to talk about risk now, and more specifically, country risk. Mining is inherently risky. You have to look at geology, you have to look at jurisdiction, you have to look at commodity risk. How do you balance all of these different types of risk, and how do you mitigate them?
Yeah, with a lot of sweat and heartache, I would say. You know, this is it's a sector not for the faint-hearted, that's for certain. But I think the first place we start really is liquidity, and particularly in the gold sector, there's not great liquidity, so it's always an issue for us. So we have to manage positions accordingly based on that liquidity. If it's a low liquidity stock, we obviously can't take all of it. And then also our ownership levels is also a constraint. You know, we're not going to typically take on a huge percentage of the company if it falls outside of our constraints, because that doesn't help the liquidity either. So, you know, it falls back to your early question, Jimmy, of size of company. You know, if a company's too small, we can't help them that much because we can only take so much of their, you know, a certain percentage ownership. But that's sort of where we start. Like, does it make sense in sort of size and liquidity? And then we balance sort of elements of where the countries, what region they are, what commodities, and what stage of development they're at, whether they're, you know, all the way from exploration to producers. There's always you know, by virtue of where the benchmarks of our funds are, and just the sector generally, there's always a bent towards the larger caps, and you know, those are obviously more global, and whether that's in the precious metal funds or the mining funds, you know, they dominate a big part of the market. So we'll always have the largest proportion of our portfolio holdings will always be in those companies, and the rest will move around. You know, we might have an overweight position in copper or an underweight position in copper, depending on how we feel about that commodity. But often, you know, particularly in copper, there aren't that many copper companies you can invest in. So it can be very stock specific. You're investing in a company because you like the jurisdiction or you like their stage of development or something like that, rather than specifically the commodity. Gold is very challenging because you know, the two largest gold companies in the world, you know, sort of 40% of our benchmark. So it's an overriding constraint on liquidity and positioning overall.
Cailey, I want to thank you very much for taking the time today and sharing your thoughts on the mining process.
Oh, my pleasure, Jimmy. Yeah, it's been a blast. I've really enjoyed it. Thank you very much.
Well, that concludes our Copper Conference, and I want to thank you for spending time with us today, and I hope you found it informative. If you did not have a chance to view all of the presenting companies, check out the replay on our YouTube channel, Bloor Street Capital. We have some amazing interviews coming up in the coming weeks with some of the world's top mining companies, so make sure you subscribe to the channel and hit that notification button so you can be kept up to date. Once again, I want to thank you for your support.